Good morning, ladies and gentlemen. Welcome to episode 2 of our interview series titled Winning Over Volatility, organized in association with Mirae Asset Investment Managers India Private Limited. In this series, we discuss how you can manage your mutual fund investments amid the economic downturn. I have with me Mr. Mahendra Jajoo, Chief Investment Officer, Fixed Income, Mirae Asset Investment Managers. And the theme for the episode is the importance of credit risk in debt mutual funds. Welcome, Mr. Jajoo. It is a pleasure to have you here today.
Thank you so much for inviting me.
Sir, the first question to you. Why should one invest in debt funds in the first place? Do debt mutual funds provide a good alternative to banking products and government schemes?
So I think the history is a good indicator. If you look at the last 5, 10, 15, 25 years, the debt funds have consistently given good returns, and the returns have been comparatively superior to other options. So there are enough number of studies available on the net, in the print media, and television channels regularly publish that the debt funds have given historically better return than all other available options. There is a limited amount of investments people can make in small savings, etc., which are in a way a bit of a concession or subsidized, or there is some amount of subvention. But by and large, look, the debt mutual funds are market related product, and market is the best compensator. So if you look at the equity funds, which are so much more popular over the last 25 years, when the India's story has been hot, has given on an average about 15% CAGR. And during the same time, the debt funds have given about 8% CAGR. So by and large, it's a very attractive return, half the return of equity at a significantly lesser volatility. So not only from an absolute return point of view in comparison to other options on the debt funds, even as a portfolio diversifier to have a better risk adjusted return, I don't think there is any substitute for the debt mutual funds.
Right, sir. So debt mutual funds are stable. They provide steady returns over a longer sort of period as well. Is that true?
Absolutely. I mean, the data is there. So I think there is a lot of misconception, mostly because of lack of interest or enough study. But people who understand debt funds, there is only one risk investing in debt in general. And I think that you have very rightly chosen the topic of that, the credit risk. I think it is very, very simple to understand. It's at the very basic of lending, that if you lend money to someone and the money doesn't come back, then all your return calculations are invalidated. Therefore, any sensible person will lend money only to the people where he has a very high degree of confidence that the money comes back. Right. Now, if in the order of hierarchy of the safety of return of the principal, and is generally reflected in all rating methodologies, whichever format they use, whether it is rating agencies or other analysts, the sovereign debt is the most safe because the government has the taxing power, and then it comes down to the PSUs, then it comes down to the banks, then it comes down to the stable business with stable cash flows. Then the commodity cyclical businesses which have more effect of the change in the economic cycle, and then the weaker grades and so on. So the way you evaluate any company, whether it is for the debt or for the equity, doesn't change. So if you are happy to lend to the sectors which have suffered the maximum stress in the last 5 years, and let me name 3: infrastructure, real estate, and the second tier, third tier NBFCs.
So what are the risks involved in investing in debt funds? And you mentioned credit risk. So why is controlling credit risk so important in the first place as compared to interest rate risk?
Yeah. So let me start with suggesting that the credit risk is not the only risk when you invest in debt funds or in any debt product. There are primarily 2 risks that you can take in a debt product. One is the duration risk or the risk of the interest rate volatility. The other is the credit risk. These are the 2 primary drivers of the return and also the two primary risk factors when you invest in the debt funds. Now, if you look at the history of the interest rates, interest rate is today the most tightly regulated product anywhere in the world. The central banks and the governments are constantly monitoring macro factors like inflation, rate pickup, and so on. And there has been a tendency to bring down the interest rates in support of the economic growth. So, however, the inflation and the other macro indicators are very volatile. Therefore, interest rates by nature are very volatile with a very short life cycle. But in terms of the long-term movement, the interest rates tend to move in a channel. That means they go up and come down. And then historically, at least for now, they have been trending downwards across the world. Now, therefore, if one is opting for the interest rate volatility, which means if one is investing in the duration product, then there is no fear of the eventual loss of the return of principal or of a reasonable return, because interest rates will be volatile. So as long as you have the time on your side and as long as you are patient and you don't panic, then at the end of the cycle, when the interest rates are in your favor, you will end up with a good return. Right. However, the credit risk is a little more complicated, because the challenge with the credit is that if there is a default, then all the return calculations, as I mentioned earlier, will be invalidated. I think that the credit risk is therefore such a sensitive factor, and it is very important to make sure that we invest in credits which are high quality, where there is a reasonably higher safety of safety and the expectation of the return. Because if the credit default happens, then all the return calculations will be invalidated for a long time.
Right. Thank you, sir. So is this a good time to invest in debt funds? How do you create a stable debt fund portfolio, especially in light of the current economic crisis that we are in?
Yeah. So I think, first of all, it is always a good time to invest in debt. A lot of people generally feel very, very skeptical, and from the time the interest rates were 9% on 10-year government bond to today when it is 6%, at all moments people keep giving me suggestions that interest rates have already fallen, how much they can fall. I think if you start looking at debt as a asset allocation into your overall portfolio, then every time you have an incremental cash flow or income, there is a time to invest in debt, because a certain percentage of that should go into your portfolio allocation. And therefore, let's take example of a typical salary earner. Every month he is getting some salary, a part of which is spending on his household consumption, part of it is spending on his EMIs and other obligations. Right. Then whatever is his net savings, that is now required to be invested in the proportion that his asset allocation suggests. Therefore, I think the first question, that there is never a good or bad time to invest in debt. It is as long as it is an asset allocation. The second is, the moment one looks at the debt as an asset allocation, the overbearing feeling of safety, etc., will disappear, because someone who is going to earn his salary for the next 25 years will continue to have the surplus. Therefore, he has a long-term investment horizon. After having allocated to debt out of his portfolio, what proportion should go to liquid fund, what proportion should go to bank FD, what proportion should go to bond fund, is then a function of his risk appetite and his investment horizon.
Right. Thank you, sir. So those were the three questions from my end, and we will take a few questions from some of our readers who have reached out to us on social media. The first question is from Sunil Saini, and he asks, given the recent closure of some debt funds, are these safe investment options anymore? And this is a very pertinent question considering what is happening right now, in the past few weeks, right?
Absolutely. I am very confident and I can say with the highest conviction that it is a question of making the right choice. If you look at again, I give the equity market example always because it is easy to understand for people. Right. Every month, every quarter, every year, we have 2, 3, 5, 10 stocks which go bust. Right. Everyone has that WhatsApp list where, so many stocks have fallen more than 90% in 2020, 2018, 2013, 7. What I'm trying to say is that it has been always the case. So there are rotten apples in every market. We do not think that the equity markets are bad or we should not invest in equity, because there we understand how to make the right choice.
Right.
I elaborated in more great details as to why making the right choice is the, if you look at the debt funds, over 25 years, there has been one or two such casualties. And those casualties are completely isolated events, wrong choice by the investors to get into the aggressive credits, in my view.
So the second, thank you for that. Second question is from Soham Gangopadhyay, and he asks, in terms of an interest rate surge, are investments in debt mutual funds beneficial?
Yeah, so I think that's again a very good question, like the first one. See, interest rates are very volatile, and the things change very fast. I think the world generally changes very fast. We spend so much time trying to project future. Now, if you look at just 3 months back, no one had a clue that the coronavirus will cause such a paralysis of the economy. Now, just before the coronavirus crisis broke out, we were suffering from, or we were facing a very tricky economic situation where our fiscal deficit was going up, our growth was slowing down, our inflation had spiked to 7.5%. Therefore, the interest rate outlook was turning somewhat negative. And then, because of the virus today, and because of the need to support a revival in the economy once the lockdown is lifted, all the central banks all over the world are going one after another to bring down interest rates, etc., because that's the only hope for the recovery of the economy once the medical situation is under control. So things change so fast that all the views that we take of 2 year, 3 year now is very, very irrelevant. And therefore, I think to be able to get the full benefit of the interest rate cycles, it is important to have a flexible investment strategy. And like in our fund, we do not spend too much time worrying about what will be the interest rate 2 year, 3 year down the line, because no one has ever got it right. At least we haven't. So what we focus on is a high quality analysis of all the factors that we know, and on that basis make a portfolio. Tomorrow, if there is a new event like coronavirus has changed our outlook, happens, or new information is available, we change our portfolio accordingly.
Of course, of course. Thank you, sir. That was very enlightening today. I think we had a very insightful discussion. Thank you, everybody, for tuning in. We will be back with the next episode soon. Stay safe and keep watching.